What's going on, guys? Bexio, and today we've got Elon Musk and Tesla announcing their 3-for-1 stock split. Another stock split for the company. Their previous one was a 5-for-1 just a couple years ago, and the stock has gone up, I think, like 200% since their previous stock split. So it seems like maybe they're adopting that same strategy of using a stock split to try and gain some interest in your stock. They're a heavy retail stock. Retail investors are massive in Tesla. They were massive before Tesla really got really big, and they continue to be massive and super supporters of Tesla even to this day. So, pretty hardcore fan base. Rallying them and lowering the price of shares psychologically could get more people involved and more money invested. Just how people kind of work. It seems like adopting a strategy of something like Apple, where they are announcing stock splits when they're kind of getting into the higher middle hundreds of dollars for a share to bring that share price back down to around $100 and get people to just kind of feel like it's not that expensive for a share of Apple. Same kind of concept here. The biggest difference, though, is Tesla does not make the money Apple makes. So this short-term kind of gain in maybe a rush to buy the stock before the split, or maybe newer people or people putting more money in after the split, might be good short term, but long term, you got to actually have the company doing something, because the stock splits do not change anything about the fundamentals of the company. And although Tesla does make like 16 to 18 billion dollars a quarter, they're doing well as a company. Do they actually deserve the status that they got, which was like $1 trillion company? They're not worth that now, but when they got there, do they actually deserve that with something like Apple at two and a half, call it 3 trillion at that time? Was Tesla really worth a third of Apple? I don't think so. And then if you look vice versa, Apple was worth way more than just 3x Tesla. So when you look at it that way, you could see maybe Tesla's a little overvalued, and maybe they're using these stock splits to generate hype and try and get people excited about the stock, which a lot of companies do. But we can see from this that Tesla's 3-to-1 stock split just approved, and we can see their first announcement was to propose 3-to-1 stock split in June as a way to make this $925 stock more affordable based on today's closing price when this article was written, the 4th. And the new share price would be around $308. So it's a little bit lower than that now because the stock has moved down. But when they're saying to make the stock more affordable, that doesn't really make sense in today's kind of investing age where fractional shares are a thing. So it's really not making the stock more affordable, because you could buy half of the stock, a tenth of the stock. You just have fractional shares. A lot of brokerages offer that. What it really does is make options more affordable, where the price of options goes down or the cost of the contracts go down, and that obviously has a lot of pressure, can add to the original share price. If a ton of people are buying calls, it can push the price up. A ton of people buying puts could push the price down. So the option market could have a little bit of influence of the stock price. Making options cheaper might give you a little bit more volatility, a little bit more upside. You can see this is where it surged more than 200% since the last stock split in August of 2020. Very different market now, though, and we'll see that on the Tesla stock chart. 2020 was absolute euphoria. If you announced a stock split, people went crazy. They tried to front run it. You had massive moves up. Apple and Tesla both saw that, massive moves up on announcements of their splits. The split happened, sell off a little bit, and then continue their uptrend. So these companies kind of had perfect timing. Right now, not that same market. We can see Tesla right here. This is Tesla stock, down 7% today. Not a great day for Tesla stock. Pretty mixed day in the market. I mean, a lot of red, but smaller companies having green days, Bitcoin companies being green. It's all mixed around here, but Tesla, you see, kind of announced their stock split, and there isn't no rally here. Last couple of days, no rally, actually moving down off of the news. So interesting to see really why there's no like front running or rally or want to get behind this, because at least sometimes there are, but a completely different market now where people are scared, more panicked, not euphoric, and this news doesn't have as drastic effect on the stock price as it did in 2020 when they first originally did one. But with this stock price of $860, it's going to be about $287 or 86 that the stock goes down to after this split. A lot of people are saying psychologically, people, when companies do these splits, you see this stock price at $860. When it goes down to $286, you're going to think this was an $800 stock. It should be there, it can get there again, and that's why people flood in. So, but stock splits change nothing about the company, nothing about the fundamentals. It might be exciting short term, but if the company isn't growing, moving forward, finding more revenue, making more money, doing something innovative, then it's only going to be short lived, and no one's going to really care about the move in stock price or the reduction in the stock price itself. Really going to care about what the company's doing. So this seems like maybe trying to adopt Apple's strategy, where we know Apple is this stock that kind of did the same thing, had its stock split, and just saw a massive rally up $182. I think that's up about 100% from their stock split around there. And that's massively good for Apple, the largest company in the world. Doubling is a big thing. And you can see even Apple, through this recent time had its big fall, but now we're seeing massive recovery for something like Apple. And Tesla isn't really seeing that. I mean, it's getting a recovery, but nothing, it's nowhere near its previous high here of almost $1,300. Whereas Apple is kind of, it's $20 off from its all-time high, which is a lot for an Apple stock. Again, the world's largest company, but this is not having to announce a stock split, no real hype, just kind of markets doing its thing, recovering, and Tesla seeing the stock split and it's still falling. So the strategy Apple takes with its stock splits are always that it wants to make the stock affordable. That's what it used to be. That's what everybody says nowadays too, but it's not really true with fractional shares. It's really about the options market. But it used to be that Apple wanted its stock accessible to everyday people and not to just make it ridiculously expensive, because fractional shares is a very new thing. But you would do it around $400 a share would be when they split it, usually a 4-to-1, get the stock price back to around $100, and then go from there and let the company grow, continue moving forward, and maybe in the next 4 or 5 years reach the $400 or $500 a share again, do another stock, which is a pretty good strategy because they are the most valuable company in the world. And you can see this is exactly what we were just talking about. Stock splits don't impact a company's market value, but evidence suggests that by making shares more affordable to retail investors, the move does often provide a short-term boost to the share price. Keyword there is short-term. So you can use stock splits to kind of get hype, get more people involved in the company, but ultimately if you don't grow the company and grow revenues and continue moving forward, you're probably going to lose that hype pretty quick, and your stock would just drop off after that. So you still have to move forward. You can't just say 3-for-1 stock split and then 2 years later say we're doing another 3-for-1 stock split and just keep going down that route if you're not evolving as a company. And not to say Tesla is not evolving or Tesla won't do anything. I think Tesla is probably the best automaker to be able to go ahead and make $100 billion a year, but they're just not there yet. So it's just something to keep an eye on and just make sure they're moving forward. I think Tesla's going to do it. Seems like a pretty good company, but it's not a strategy to just continue doing share splits to try and get your retail investor crowd excited again and make those options affordable. So we just got to keep an eye on the fundamentals and stuff. But it's not the only stock split we saw, this year even. We saw Google announce that it's doing a 20-for-1 split, and Amazon as well, a 20-for-1. So everyone's trying to make their stocks more affordable, the option market more affordable, but as well as psychologically lowering your share price to the hundreds of dollars instead of multiple thousands of dollars is a pretty big deal. People look at that and think that's way more affordable and it can get back to those levels when it's really not the case, but a lot of people think that way. Usually even this market strategist talks when stocks trade in a so-called comfortable range, everyday investors can more easily afford a piece of the company. That drives more interest in the shares, and more interest means more people trade in the stock. More people trading means the price goes up. It's a win-win for everybody, at least short term. And you can see this is the big critic of Tesla. And people who say Tesla's overvalued could be right now. If Tesla doesn't find a way to substantially make more money, it's priced to make lots of money in the future. And if they don't do that, they're going to run into pretty big problems. But you can see right here, the current valuation remains challenging, especially when considering that few other companies that have achieved a similar market cap did so by generating, on average, around $100 billion in annualized gross profit versus Tesla's annualized profit of $20 billion in the first half of the year, the firm points out. So, 20 billion would be 40 billion, still 40% of what the other companies achieved in revenue to be able to get that same kind of market cap Tesla got. So it's a strong argument that Tesla could be overvalued if they keep moving forward. I mean, people can continue saying Tesla's overvalued for the next 5 years and Tesla doesn't come down and keeps going higher. It's a complete possibility. But Tesla right now could see downside, especially seeing that right here the stock split announced and it's fallen since then very recently. Not a great first kind of look into that. So the stock split from Tesla, probably a pretty smart move to keep the stock within the low hundreds to try and get people more enticed in buying the stock, lower the price of options, bring more people, more retail investors into the stock, which Tesla's a huge retail stock. So it makes sense from Tesla, makes sense short term. Long term, though, it doesn't matter. The stock split doesn't matter at all. Fundamentals of the company matter. Tesla can get there. Tesla can make tons of money, but they're just not there yet. So the stock split ultimately doesn't really mean much. And we got to see Tesla keep making more and more money to justify, their pretty big market cap. But that's going to do it for this video, guys. As always, don't forget to smash the like button and subscribe. We're on the road to 1,000 subscribers. And I'll see you guys in my next video.